for joining for today's earnings release and strategic update for Hela Apparel Holdings, covering our second quarter results, and then also a bit more of a broader update on the strategic positioning of the company going forward. Thank you in particular to those who've joined us physically. You are currently sitting in our kidswear office, which is, I hope, very impressive as well. And thank you to everyone who's joining online and taking the time out of their Friday to do so. So just for the benefit of everyone online, my name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined by our Chairman, Mr. A.R. Rasaya, our Group CEO, Mr. Dalanka Jinadasa, and our Group CFO, Mr. Ruan Fernando. Before I hand over to Mr. Rasaya to provide some opening remarks, I will briefly run through our normal disclosure on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainty that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligations to update these statements to reflect events or circumstances that may arise. And with that, I would now like to ask our chairman to provide some brief opening remarks.
Good afternoon and welcome. The table at the head table has already been introduced by Dalanka. We normally have a Zoom meeting every quarter. Being a very transparent company, we thought we should have a few people present at least so that we can see them face to face, ask the relevant questions, and we can give certain answers. And to start with, I must say, when trouble doesn't come single, we started with COVID when we thought we can lift our head with COVID, but the COVID had its effects, and both UK and USA had a downturn. You can call it inflation, you can call it recession or whatever. The market certainly got hit, and we were just feeling the pulse of it. Then, of course, came the Ukraine war, and add to that, now the Israel war has come. That's not all. There were enough and more problems, and obviously, our customers also felt the pulse. And they were also asking for various concessions and, what shall I say, discounts. We lost actually a good part of two of our major customers, a good percentage. But of course, there are others who lost more or gave us less orders, but never say die. We still carry on. And add to that, we have also had the pushbacks, postponement, cancellation of orders, all that comes. As I said, trouble doesn't come single. So those also happen. But the worst is it became a customer's market, and they were able to dominate and make their demands. In fact, we have lost some customers fighting for 15 cents, 20 cents dollars, but still we kept on going. But having said that, we also must say that when the going is tough, the tough gets going. So we also have been equally resilient. We are also taking very, very serious and drastic steps to control and improve. And the first, of course, is the cost reduction program. We have to keep our staff in mind because, as you know, staff is our biggest asset. So we cannot get rid of, get rid of our staff immediately. But we had to make a balance between cost reduction, staff reduction, so that we become cost effective, so that we can meet the demands of our customers. Next one, of course, I must say, our staff relatively are young, very resilient, and very, very innovative. And that is one of the reasons why we are still surviving, which of course don't come in various articles and comments, is the very reason why we are surviving. They're very innovative. These customers are very big. They deal with the big customers in Sri Lanka also, but still they continue with us because of our innovative ideas. Having said that, I would also say all is not lost. We have got some very good new customers, all that will be presented as we go on, who are both innovative and are very demanding, and two of them are really, really big, and they have really given or planned with us to give more orders and more relationship with us. And of course, we have been very, as I told you, very, very innovative. And not that I am saying that we are doing very well or doing very badly. I would say the worst is over. We have seen the bottom end of the curve, and the curve is moving up. And hopefully in a month or two, we will be positive. And next year, early part of next year itself is looking very good, especially for our Sri Lankan factories, which are really getting filled up. So things are not that bad, and we are not given hopes, and certainly we are going to be resilient, and we are going to come back. And that is one of the reasons we are having not only a Zoom meeting, a face-to-face meeting also, so that you could ask any questions face-to-face and get it cleared. So my colleagues are here who will answer any clarification. So now we'll hand it over back to Adam. Thank you, Adam.
Thank you, Mr. Rasaya, very much for those opening remarks. So we'll now move on to the presentation section of today's session. So this will be around 20 minutes. So I'll run you through our, I'm just going to jump to the content slide. If the technical team could also bring up the screen for everyone on Zoom. So we'll first run through a brief overview of our Q2 results. We'll then update on the current market outlook from a Hela perspective, and further details on our Project 180 plan to address the current challenging market environment. This presentation also includes a couple of slides on our social capital initiatives, which we won't run through in the interest of time. However, we will be sharing a copy of this presentation with everyone present and online after the forum, and we really encourage you to look at those as well. Following the presentation, we will also have a Q&A for the remainder of the session. For those online, questions can be shared through the Q&A box on your screen, and we would encourage you to send in your questions as we go through the call. For those in the room, we will also have a couple of roving mics for any questions you may have. So that's all the housekeeping. To jump straight into it, this is a snapshot of our Q2 results, which were published yesterday. So it goes without saying that it was an extremely challenging quarter. Revenue from a rupee standpoint was down by 39% year on year to 17.2 billion. And that has had an impact throughout the P&L, both at operating and PAT level. To put some more context into that, I'm going to go to the next slide. So within that 40% drop in revenue, that actually reflects about a 31% decline in our US dollar revenue, right? With the remainder being the impact of the rupee appreciation, which was about 10% year on year. And that compares with a 26% year on year decline in US dollar revenue in Q4. So it was a bit worse. And really that's being driven by weak performance among apparel brands in the group's key markets in particular. I say apparel brands because there clearly was some resilience in consumer spending. That's what we've seen in some of the recent macro data from those markets. But certainly the communications we get from our customers it's very weak from a spending standpoint. And they continue to communicate uncertainty on the timing of a potential recovery as well. And so from a profitability standpoint, there was a slight improvement in gross margins. And that's really reflective of the capacity utilization rates increasing across most of our manufacturing facilities despite the drop in demand, because of the capacity rationalization measures, which we've already taken in past quarters. So that was a marginal improvement in gross margins, but they are well below what we would call the normalized level that we would expect. And the additional major drag on profitability was a rise in administration costs, which was fairly significant. And this is partly on a year-on-year basis, it's partly a result of the rupee appreciation relative to our US dollar income and our LKR overheads. And it's also the result of one-off costs relating to some of the major capacity rationalization measures that we took during the quarter, which we will have more to say on in some of the later slides. And of course, as with previous quarters, the elevated level of US dollar interest rates is also contributing to relatively high finance costs for us as well, all contributing to what is a very significant post-tax loss. From a balance sheet perspective, so gearing from a net debt to equity ratio perspective has increased quite significantly. If I'm getting the number right, it was 3.6. And that, more than an increase in debt, is reflecting the decline in retained earnings. Long-term debt has increased, and that is because of the drawdown of a couple of the major financing facilities we established in the first half of the year. So that is from Norfund and Avishkar. But our short-term debt has reduced in line with the reduction in the overall business volume. And overall, our cash position was stable across the second quarter as well. And just, I guess, briefly to touch on the chart. So this shows our revenue composition by country of manufacture. So with the dark blue bars being Sri Lanka, and then the lighter bars being for Kenya, Ethiopia, and Egypt. So I think the key message here is really that from a demand standpoint, Sri Lanka continues to be a bit more resilient. So demand for our Sri Lanka capacity continues to be a bit more resilient. And that, as one thing we mentioned last quarter, that reflects the composition of customers that we are producing for in Sri Lanka, which is more skewed towards the UK and European supermarkets, which have had seen more resilience in their demand, compared to in the African manufacturing plants, where it's more exposed to US brands that are heavily in wholesale channels that have struggled heavily. So that's kind of the reason why you see that composition shift, whereas last year we had a shift more greatly towards Africa. This year we're seeing it come back a bit towards Sri Lanka. I think the one exception to that might be Egypt, where we're seeing a bit more resilience in the demand there. Okay, I think to move on to the next slide. So this is putting our quarterly performance into additional perspective, showing it against the quarterly performance over the last 3 years. So I think a couple of things I want to pull out from this. One is the fact that on a quarter-on-quarter basis, our revenue was actually stable. So this is slightly up in rupee terms. In US dollar terms, it's slightly down, maybe like 1%, but basically stable. And that is the first time we can say that for about 4+ quarters, right? So, the interpretation of that is a question mark, but that is we take as a positive sign. I think from the operating profit side, obviously it's disappointing to see the operating profit or the operating loss increase in Q2, but we would highlight the one-off restructuring costs that we had in the quarter as one of the important contributors to that as well. Move to the next slide. I'm going to give you this is a brief snapshot of our capacity and how it looks from a volume perspective. So the chart on the right is our sold standard hours, which is how we measure our capacity in the last 4 quarters, shown at the group level and then at each country level. So I think overall we saw a 20% quarter-on-quarter decrease in standard hour output in Q2, which is significantly down from the previous year. It's about 45%. And that is being driven by declines in Sri Lanka and Kenya. But because of the capacity rationalization measures we did take in the past couple of quarters, there was an improvement in capacity utilization from about the mid-70s up to above 80 as well. And I think, as I mentioned, we are seeing we're still seeing, while sold hours was down in Sri Lanka in the last quarter, it's still showing relative resilience to some of the African manufacturing footprint because of that customer composition. So this is the final slide on our Q2 results. I'm now going to move on to how we see the market outlook. So this is a quick snapshot. So basically the key takeaway messages are, we see tentative signs of a stabilization in demand, right? And kind of that Q-on-Q stability in our revenue is kind of the first sign of that. And we do see it in our forward order book as well. But the results of major apparel brands do continue to highlight weakness in consumer demand for apparel. So particularly if you look at some of the global brands and the well-established global brands, they will highlight weakness in the US and Europe, which is being offset for them by some strength in Asia. Obviously, you have 1 or 2 exceptions to that, which, certain brands which continue to do well even in this environment. But that's kind of one of the key messages we take away from some of the communications of our major customers. And among those customers, we are seeing an ongoing reduction in inventory levels, which we believe will be supportive of the eventual recovery as and when it does come. So it is really that tentative signs of stabilization. Currently, it's relatively positive. It's not a huge recovery, but it's a positive sign. The caveat to that is that there are definitely risks on the horizon. While it does seem that major central banks have completed their tightening cycles, there is always that risk that if inflation doesn't come down further as they expect, because economic conditions have remained relatively strong, that we'll see them hike rates further. There is also an argument that the strength in consumer demand has reflected some specific factors like post-pandemic savings, which may now become exhausted, right? Which may contribute to a weakening again in consumer demand. And of course, we have a very volatile global geopolitical environment as well. So conflict in the Middle East goes without saying, but also there are major elections in the US and UK next year. I think in the UK in particular, we'll be looking at a change of government as well. In the US, of course, we have the potential for a government shutdown again in the not too distant future. So kind of positive signs, but it's coming in quite a kind of complex set of risk factors. And that is also the communication we get back from our customers as well, is that they're also seeing positive signs, but it's not yet cemented for them to really take a positive stance. go to the next slide. So to put some more context on a kind of the overall macro picture, sorry, I'll go back a slide. This slide and the chart on this slide shows US real personal consumption growth quarterly for the last 4 quarters. And this split into, on the left side, goods, and then in the middle, services. And then from goods, I've extracted the rates for clothing and footwear. So really the 2 key messages I want to bring out in this is that within what seems to be overall relatively resilient consumer spending, what's actually happening is that services spending has been very strong. And that's that whole post-pandemic effect of after no one being able to spend on travel or hospitality, everyone's shifted the wallet share back to that. So we're seeing that kind of continue. Secondly, within goods, so this is in the US in particular, we've seen a recovery in goods spending in the last couple of quarters. But if you look at that, the gray and the yellow bar, which are the last two calendar quarters, you see that goods spending has done pretty well, but spending on power products in particular has been weak. Now, there's lots of speculation as to the reasons for that. But what it does seem like is that spending on durable goods is a bit stronger. So that people are potentially being a bit more selective in some of their spending decisions. But that is obviously very open to interpretation. So it will be interesting to see how that evolves over the coming quarters. But this is something we're seeing across our markets in US and in Europe as well. And I think really it comes down to the fact that we are still, years after feeling some after effects of the pandemic and the huge shifts in consumer behavior that it caused. So this will take some time to play out as well. So if I now go to a snapshot on our demand visibility. So the chart on this slide is showing, similar to one of the previous charts, this is showing our monthly loading from a standard hours perspective. And then the light blue bars on the right-hand side are our current visibility, our current forecasts. So in the first couple of months, that will be mostly based on confirmed orders, but as it goes further out, it's obviously based on kind of customer communication and becomes more uncertain. And then the red dash line is showing our approximate capacity, which is quite volatile from month to month. So this is just a kind of rough guide. So I think the key message is going forward, we do see a rise in loading in Q3, but it's not significant compared to historical periods. But it is there, and it is indicating a greater period of stability as well, I think. And then within that context, because we've reduced our capacity quite significantly, actually a monthly capacity in the middle of last year was in excess of 1 million standard hours per month. We are now at a much better level to match our capacity to this level of demand, as it kind of remains, stable, but not necessarily a huge recovery yet. So that is the overall picture as we see on the demand side. I'm now going to run you through a few slides on Project 180, which is essentially the turnaround strategy that we announced last quarter. And so we spent the last few months in full implementation mode for that. So we wanted to give you kind of a clear update on some of the measures that we've taken. So there's 4 key pillars of the program, of the project, sorry. So as a reminder, the first and obviously most important is cost and capacity rationalization. So we have assessed all areas of the business for cost optimization, essentially to ensure that our break-even rate is reduced to the current levels of demand. And kind of supporting that is our journey on operational excellence to ensure that we continue to have the highest levels of productivity. And that's underpinned by our new digital core, supported by SAP. Of course, on the demand side, it's an increasingly competitive marketplace. So it's critical that we proactively continue to respond to our customer needs. And this is actually something that's a core strength of Hela, and it's something that's allowed us to continue to onboard new customers, new high-value customers in this environment, which I'll touch on in some of the subsequent slides. And at the same time, while this is a very challenging environment, it's not one in which we can entirely stand still. We do need to be looking at how we're positioning ourselves in the industry going forward, one that is becoming quite challenging, and there's huge shifts going on as well. So strategic investments is something that we're also looking at, which I'll touch on in a subsequent slide. So to start by giving you a bit more of an insight into the cost and capacity rationalization pillar. So we have taken some important and some difficult decisions over the past quarter. So that is really around cost rationalization. So on the manufacturing side, the single biggest thing we have done is we have transitioned our Kenyan manufacturing plant, which is the group's single business, single largest facility, to a single shift. From previously, it was on a double shift operation. And that has resulted in the redundancy of about 2,000 employees, which is very significant. That is also significant because it's our largest manufacturing facility. In the last year, it was about 40% of our revenue coming out of that factory. So it was a very significant base. When we were, seeking to hold on to that capacity in the expectation of a sooner recovery in demand, but we have now taken that decision, and you see that that's resulted in quite a significant saving. In addition, we've continued to do other measures like recruitment freezes across all of the manufacturing base. So actually, our total number of employees has come down significantly over the past year, by about upwards of 30%. And also a number of smaller measures on transport, machine rental, and other overhead costs. From an SG&A perspective, we've also been on a campaign of mandated cost reductions across all functions. There's also been a centralization and restructuring of staff at those levels and removal of certain employee benefits to bring down costs. And then also there's a recruitment freeze also at the executive cadre level, and leavers are only selectively being replaced. So the overall target of all of those measures was essentially to reduce the break-even point for the company to around $18 to $19 million in monthly sales, which was about the sale level in the past 2 quarters, so in Q1 and Q2. So that's really what we're seeking to do, to really reorientate the business to this new reduced level of demand. In terms of our progress, so the table at the bottom of this slide gives a snapshot on where we stand on these. So the downsizing of Kenya was completed in the month of September. So that saving is now being realized. We are still working towards the manufacturing and SG&A cost optimization line items, but we have identified significant further measures in order to bridge those gaps. And this $8.2 million saving I'm mentioning, that is the total saving between the month of August and March that we've identified from these measures. So I think I will move on from the cost and capacity rationalization and to operational excellence. So very briefly on this. So clearly last year, one of the drags on our performance was operational disruption, which really resulted in significant unplanned air freight, which is what you see on the chart on the right-hand side. So we've done a significant focus of reducing what we call a cost of failure, and that has already been realized, as you see here. There has been a slight increase in that air freight cost over the past couple of quarters, but it is very much still within manageable levels. And it is a real focus for us to maintain that as well. In addition to that, baked into the whole Project 180 plan was higher efficiency rates and some of those manufacturing initiatives as well. And then as of 1st April, we now have had full implementation of our SAP underpinned digital core, which we believe will be supportive overall of maintaining both operational excellence and also managing costs going forward. From a demand side, so on the product and services side, so 2 major things I want to mention here. So the first is we are very much making a lot of progress on diversifying our strategic relationships with our customers and diversifying some of our customer concentration. But that is certainly a journey. So 2 real highlights on that side. The first is Castor, where we're seeing a significant expansion of that relationship with them. They themselves are a very fast-growing sportswear company in Europe. And so we are now producing apparel for them for over 30 teams across a very diverse range of sports. So that's football, cricket, F1, and more recently NASCAR. So for example, we produced the England men's cricket team uniform for the recent World Cup as well. So from a revenue perspective, that's going to be a significant growth from a very small level. So last financial year, we did about 3 million with Castor. This year, we're expecting about 14 million, and for that to go up to 20 million next year. So that's significant growth from a low level. The second major brand to mention is Victoria's Secret, which is obviously well known to Sri Lankan vendors, but was new to us in the last financial year, and where we only did about 3 million just starting our relationship with them. But we have huge potential to expand our penetration with Victoria's Secret from that low level. So even despite its wider challenges in the market, it remains the biggest women's intimates brand in the US, and our penetration is currently tiny. So there's a lot we can build with them, and it's really supported by their focus on increasing African sourcing, and they're extremely positive on the Egyptian opportunity. So this yoga pants that you see here are something that we manufactured in the Egypt factory. So again, from a revenue perspective, we're seeing a similar level of significant growth coming out of Victoria's Secret over the next couple of financial years. In addition to that, we do also, even in this challenging environment, have a strong pipeline of new high-value customers. So we have, in the last quarter, received confirmed purchase orders for both Nike and Hugo Boss, which are huge wins for us, which we've been working on for a number of years. So those will start production early next year. And we look forward to growing those relationships in a similarly strategic way to Castro and Victoria's Secret. In addition, we also are currently in final discussions with the Gymshark as well. And we expect to see commercialization of that, those discussions very shortly. So really, we would say a very strong picture on the incoming customer side and the diversification of customer relationships. And one slide on our strategic investments picture. And this is really to update from the guidance we gave at the time of the IPO, where part of the proceeds was to go towards a fabric mill. Really in this, it remains Hela's vision to become a fully vertically integrated service provider across the value chain and to integrate vertically across the value chain to capture greater value. But what we've seen in this environment is that we are in a part of the value chain where demand security is actually the biggest challenge, and kind of our limited market power in being purely what we put here as an OEM manufacturer. So our key focus is now on forward integration, which will support that demand security and also capture greater value. And that strategy is strongly supported by our current major shareholders, who themselves come from that background. They have extensive experience in brand ownership and management in Europe. So they are really supportive of that direction on all fronts. But it is important to say that we haven't forgotten about the backward integration piece. We just still see that as important. It's just that will be in the future. Our current focus will be on the forward integration piece. So we're working on a number of initiatives in this area, which we hope we'll be able to update everyone on in the coming months. And so taking that all together, where we stand on the outlook. So 3 key messages I really want to leave everyone with before we move into the Q&A. We do expect a significant improvement in performance in the second half, and that's going to be supported by our cost and capacity rationalization measures undertaken as part of Project 180. There are obviously challenges on the demand side. We're still working on some of the cost measures, but we are confident we will see an improvement from this quarter. In addition to that, currently the apparel market outlook is improving, right? And we've seen that from our other peers as well. As I say, there are risks to that, but that's currently the pictures that we're going to see a gradual recovery. In addition to that, it's important to say that the management team remains very vigilant to that uncertain outlook and is ready to take any further steps that are necessary to ensure that return to profitability in the short term as well. So I'm going to close the presentation here. We can move to the Q&A. So anyone on Zoom, please feel free to put your questions in the chat box, and we will run through them. Also, if anyone in the room has any questions, I think we should have a couple of mics around, so happy to take any of those. Yeah, and I think.
Thank you for the presentation.
Yeah.
I'm just trying to understand the percent drop in standard hours along with the 1% drop in dollar revenue. And of course, your high utilization and the high utilization. So you had a 20% drop, QOQ drop in standard hours, but your revenue was only down 1%. Am I to assume that is because your order book shifted towards more higher value items, or how do you explain that?
So it also results due to open capacity. So even though you have the capacity available, the utilization of it was not at the optimum. So over the last 2 months or last 2-3 months, like what you've seen in Kenya, we've downsized the capacity so we can still hit the same revenue numbers of $55-60 million per quarter, but at a much lower cost base. Yeah.
How much do you think quarter on quarter your capacity was brought down at the group level?
So right. So if you look at us, about 4 quarters ago, we were at about 1.2 million standard hours. And now we're at about 650,000 standard hours. So from a year ago, we are about 50% down. We've restructured it to be 50% down. Particularly coming because Kenya is our largest plant. About 40% of our revenue came from Kenya, and that was halved. So that's where the biggest contribution comes from.
Usually standard hours defined as essentially is actually the output hours. Am I right to put it that way? Standard hours is your output hours, right?
Yeah.
So what I want to understand is that if you forget the output aspect of it, right, compared with, let's say, last year, if you how many hours did you actually trim down because you were expecting lower demand? Right. So by essentially, it's like if you had probably not the correct phrase for this particular industry, what is kind of your like installed capacity?
That's right. So standard hours is really your installed capacity. Produced hours is what you actually utilize from it.
Right.
Right. So our utilization, it changes because if you saw if you go back to the slide with the utilization, in Sri Lanka, we're almost at full capacity. In Ethiopia, we are running at about 80% to 90% capacity, but in Kenya, we were running at about 60 to 70%. So it varies depending on which country you're looking at. And then the overall number becomes higher because Sri Lanka is running at above 90%, and that's about 50% of our total capacity.
If I go back to the IPO time, I think we used to discuss this efficiency rate into clocked in hours.
Right.
Where the multiplication of it was roughly your standard hours.
Correct.
So it's a efficiency rate almost like how efficient are you using
From
your
a total
clocked in
clock
hours,
yes.
right?
Yeah.
So what I want to understand is that isn't clocked in hours more closer to your
100%.
installed capacity than standard? That's I'm
Sure.
trying to understand.
That is assuming you run at 100% capacity, 100%
Yeah, agree.
efficiency.
Yes,
That's your clocked hours.
clocked hours.
Then
Yeah.
you have your standard hours, which is based on your efficiency. And then your produced hours depends on how much of it you utilize.
Right. Right. Okay. So essentially you are okay. Okay.
So what was your change in the produced hours between Q1 and Q2?
From the produced hours, it was fairly flat.
So
It's very flat.
1%.
Correct. Yeah, it was fairly flat
So
because the trim down of total available hours came during the last 2 months through the restructuring.
Reduced hours was actually a little bit up last quarter.
And Adam, for Q1 and Q2, can you give a reference point for the produced hours of last year so we can see how much it has come down?
Yeah. So it was still down quite significantly, maybe like about 40%. Because of that capacity reduction.
Right. So essentially what you mean is that if the demand happens to revert in the future back to that, and you go back to a double shifts in Kenya, etc., that is what is there for you to recapture back.
Yeah.
To get that same term.
Obviously, yeah.
What we would potentially, what we decided internally is that we will not go back into a double shift till we have consecutive quarters of stability in demand and there's sufficient third-party capacity that's available.
You will first use those before
we
you
use those and then decide if we want to really internalize our manufacturing, because last thing we want is to recruit again and then restructure, because restructuring has been it's been over $1.3 million last quarter. So we don't want to go through that process again.
So it was $1.3 million in the September quarter. How much was it in June quarter?
It was more, almost everything was in the
September quarter.
Very negligible in June.
Right. Okay, I'll circle back again after others ask questions.
Sure.
So maybe in the interests of, oh, sorry, Ramit, please go ahead. Yeah.
If I may, I'm making the assumption, as this gentleman said, that if you want to increase your capacity, you can, using the methodologies that you have mentioned. But looking forward, as you had mentioned, and I think we discussed on previous calls, we are seeing a shift in the channels where certain channels are doing better than other channels. In certain countries are doing better than other countries as a result. And which is obviously why you're concentrating on new buyers. And in your industry, you have to keep on adding. There's no stopping here. You keep on adding new buyers. Some buyers will tail off, new buyers will come and take that, blah, blah, that long story. How is Hela positioned in those markets vis-a-vis its own competition? For example, as you said, companies like Victoria's Secret are looking at Egypt. Fine. So for Hela, the fact that you have a big facility there is good.
Yes.
But what makes Hela in Egypt more attractive than others in Egypt who can do a similar, if not identical thing? That's question number one.
Yeah.
Question number two is that if I'm correct in what I'm made to understand, Sri Lanka, a lot of the capacity that is being utilized now is for local production. No? Export.
All export.
So then you have no
100%.
issue about that. Okay. Because that was the concern I had, that how much more can the local market take? So as far as the question I have then is, if these buyers are going to be country specific, like Egypt or maybe Kenya for something else, what is it that Hela does that makes it or differentiates it from its generic competition in those countries?
Sure. So if I summarize it, like why Hela, right?
Yeah.
One of the main reasons is it's the first move advantage, right? We were the first to go and set up, build capacity, build capability in these countries. And we also built it, especially in Ethiopia and Egypt, we built it a little smart by going into categories which nobody else has that presence in. So if you look at our facility in Ethiopia, which is producing those lingerie items that you see there, we are the only manufacturer that produces these sort of complex products, which would have predominantly been made in Sri Lanka or in China, Vietnam sort of markets. So that is, so if a brand wants to have a source for this particular category, we are playing in a blue ocean sort of a space.
And may I say, why would a brand go to Ethiopia or Egypt? Is it a cost factor purely, or is it some other factor?
Multiple factors. If I take each one separately, with Egypt, of course, all three countries.
So just take, for example, this type of intimates or whatever you want to call it.
Sure.
It could be produced in many countries, is produced in many countries. But you're saying, okay, Egypt, for example, or Ethiopia.
Yeah.
Why there and why not? Is Sri Lanka the cost problem or?
Sure. Then, again, multiple. One is the duty-free agreements.
Right, exactly.
Ethiopia had the world's best duty-free access, but they lost America due to the civil unrest that they went through about 2 years ago. But hopefully within the next few months, it will come up for consideration again. So we'll hear back by Jan 1st. But they still have duty-free access to all other major nations. So Canada, Europe, UK, Asia, that's China, Japan, India, all those markets. So for these sort of brands that have that global presence, it's a one-stop shop destination. You look from a cost-based standpoint also, Ramli, you're looking at about $40 salaries. So from a manufacturing standpoint, also it's one of the most competitive destinations. Utility costs are about 4 cents a kilowatt hour, completely renewable. So there is a cost leadership strategy there as well. But also what's important is that, especially now, looking at the political tensions that Bangladesh is also going through. They just had a massive minimum wage hike as well, and elections are starting early next year. Brands are also starting to realize, okay, what is my next Bangladesh? How do I de-risk it? They will not reduce exposure, but where is the growth going to come from? So Ethiopia kind of sits in that sweet spot. At least it was very attractive till they lost AGOA, but now it's still, I think, very attractive because of the sheer size of the population, 100 million people, 26 million kids in school. So there's a good pipeline of working population coming in. So there's an element of that where brands are trying out Ethiopia to de-risk some of the other countries because they know, say, for example, the size of the industry in Bangladesh is about $45 billion. They know that Sri Lanka is never going to replace Bangladesh because of the sheer size. So they need to go to a country which can take on a phenomenal size from that exposure. So that's from Ethiopia standpoint. If I touch on Egypt, multiple factors. And that's why if you see our exposure in Egypt is also growing quarter on quarter. One is lead time. You're talking about 3 days sailing to Southern Europe, 7 days to UK, about 12 days to US. The supply chain exists there and it's completely duty free as well to both Europe, UK, and the US. So again, and with Egypt, Egypt is known for denim manufacturing. They made suits. So we went in with yoga pants, sportswear. Why? Of course, again, not many players that play in that space. And two is activewear has a 32% duty when importing to the US, and it's high FOB, right? It's high, like say a pant, it would be $1.90 to a $1. A yoga pant that we do for VS is about $7 to $8. At 32% duty, the brand gets a $2 benefit. Multiply that to about 150,000 pieces per month to a year.
Numbers make a lot of sense.
It's easy savings without compromising product and without the manufacturer compromising on margin.
So that's a good product mix plus buyer mix
Yeah.
strategy there. One more question, if I may ask. The forward integration, obviously, as you pointed out, is the key going forward. If I may say, the current production capacity thing, you see 5%, 10% at best.
Yeah.
Right. The real gains are going to come on either side of your production. Are you in a position to give us any milestones that you have in place for this, or is it too early to talk about?
We're targeting to complete it this quarter.
Okay.
So
Complete what?
the transaction, this forward
Okay.
integration transaction. So we're working.
And
with
that would entail
that would entail an potential acquisition.
acquisition. Okay.
So we're working very.
But that would be at a not at this level, right?
That would be under the main holding company.
Right.
That's how we again. I can't share too much
Fine,
detail as
yeah,
of
I
right
understand.
now, but we're looking at completing it. We made a decent amount of progress. It's at a due diligence
Okay.
phase and working very closely with our main shareholder because, like Adam mentioned, they come from a retail background and they want to take a lead role in.
And the benefits would flow through to
100% of it. So we see multiple synergies with this strategy, right? Because if you look at it inherently, this quarter, we had a 31% drop in revenue from dollar terms. I know it's 39 in rupee terms, but in dollars, it's about a 30% drop. So if we can drive, yes, how do you manage that? Is you match your cost base also to offset that. But also at the same time, we need to put some focus on how do we drive revenue up as well, because this is a never-ending slide, right? So this gives us multiple synergies. One is it gives us some form of demand security because we can decide as to where we manufacture these. And there is also ways where we can use that infrastructure to help our core business here as well, through design, through sales offices, warehouses in the UK and Europe to fulfill our existing customers. So there's multiple ways that we can do it. And if you look at our customers, especially out of this office, which is the kidswear office, our customers are supermarkets. And if you see the supermarkets also, they're moving from having their own brands to having multiple brands in those channels. So how can we take some of the IP brands that this particular vehicle has and then sell it to these same customers is really where we're trying to go.
again, some of the other investments that we manage, we see this as the real impetus for growth going forward rather than, I mean, you have to optimize your cost structure, your capacity and all that. But this basically is going to be your.
We strongly believe in that. And I think more than going backward integration, going
forward
towards the
part.
consumer.
It gives you security as well,
gives you
more
security,
consistency in your quarters.
margins. Yeah.
Thank you.
We'll maybe quickly take some questions from online. So a couple on the finance side, which Rowan, I'll give to you if you can take that mic. So the first one is, a couple of these are quite specific, so I'll just run through a few. So what is the percentage of freight charges included in distribution expenses? And can you specify any other expenses included in that category? So maybe you can go ahead and answer that.
Yeah, so our freight percentages is normally, if you take as a percentage of sales, overall it's about 4.1%, but 4%, it depends on the location. Egypt being the highest, it's about 8%. Sri Lanka is about 2% because predominantly we
There is that what something our logistics teams have also managed to do was in April, we negotiated a 1-year contract with Maersk, where we fixed our rates. So even though we are seeing certain freight rates rise on certain channels, we are not affected on this. So in April
last year.
with the volume commitment this year.
One question on admin costs, if I can give that to you, Rowan, as well, is there an additional explanation on the year-on-year and quarter-on-quarter moves in admin costs?
So quarter on quarter, as Adam mentioned in his presentation, it's mainly because we had a lot of restructuring expenses that came on the last quarter in terms of restructuring that we did in Kenya. And we have also done certain restructuring in terms of our SG&A staff. So that VRS cost has been included in the last quarter performance. Apart from that, we are seeing exchange rates also have moved, or rupee has appreciated. So there's an impact there of about 400,000. VRS is about 700,000. If you take year on year, there's increase in terms of our people cost, because we had to take certain cost in terms of reimbursements, because when the taxes went up, we had to really increase. So we went with 100% reimbursement of the increase in taxes to retain people. And those are some of the benefits that we are now, as Adam's presentation, we're trying to see how we can remove, because we need to really get our cost to a sustainable base. So it's basically admin cost, salary related, VRS cost, and exchange rate impact.
Thank you, Rowan. One question on our raw material sourcing. Can you explain the raw material sourcing process of Hela, including the countries from which you are sourcing?
It really depends on the country we manufacture, because we want to be as nearshore as possible with our sourcing strategy. So when it comes to Sri Lanka, and that's why Sri Lanka has the lowest freight component in our across the 4 countries we are in, because we either buy locally or we import from India. Again, the freight cost is extremely cheap. Something which we are proud of what we built in Kenya is that we've developed a fabric mill over in Tanzania. So nearly about 80% of our fabric requirement for Kenya now comes from Tanzania. We've also taken a Sri Lankan packaging manufacturer called JFNI to come and set up right next door to us. So all our packaging needs comes from there. Indian elastic manufacturer, we've taken them over to Kenya again onto the same path that we are in. So we built the supply chain around us to service men's underwear out of Kenya. So that's how Kenya relies. Egypt also has its own supply chain. Those who I believe from all the countries we are in, Egypt has the strongest local supply chain, and Egypt being so close to Turkey can rely on Turkish supply chain as well. Where we have a high level of imports is really in Ethiopia, which is where we rely on Sri Lankan and Far Eastern supply chain when it comes to that. So a lot of the major benefits of being in Ethiopia is eroded because of this high freight component. But still, even after factoring that in, it's our most profitable entity with double-digit NP margin. So it still works with the importing strategy.
Thank you, Jonka. A couple of questions from online on the debt portfolio. So can you specify the proportion split between floating rate and fixed rate borrowings? And also, were there any additional borrowings during the quarter? So Rowan, I can give that one to you.
So in terms of interest rate, almost all our borrowings is floating. It's pegged on SOFR. In terms of borrowings that we have made, during the last quarter, it was basically from Norfund and Avishka. There was a facility approved from Norfund, about 14 million, of which we have drawn down 7 million. And from Avishka, we have drawn down 3.25. So Norfund mainly came to Kenya into fund capex for growth. And Avishka again is dealing with mainly Egypt.
Yeah, Naveen, go ahead.
You're at a 7-notch rating downgrade by Fitch. How are the banks reacting to that? I see a few banks in the room, and how are your creditors reacting to that?
you want me to take that? Sure.
Sure. I'll take
Yeah. So maybe I'll take a couple of points.
Yeah.
So I think obviously we don't agree with Fitch's analysis. In short, I think would be the point. But it's in terms of the numbers, I don't think it's any major surprise to anyone who works with Hela closely, including our bankers. So I think just if I tackle some of the questions like one by one, so the first kind of suggestion that our financial transparency is weakened, we would completely contradict and say it's actually the opposite, right? So that adjustment which came out in our audited accounts, which was arising from our transition to SAP, really reflects the limitations in some of our previous systems, right, of which they were very numerous. So actually it's the clearing out of all of those issues so that now we're on a much more solid base and actually are more, have a stronger financial base in our financial reporting as well. I think secondly, in terms of the forecasts, we see a much more positive picture. And as you will have seen as we ran through this presentation, we have made significant progress on the overall turnaround strategy that we don't feel that Fitch has taken account of. And so we do disagree very significantly on the forecast as well. But Delanka, you can add on.
That's what I was going to say. I mean, the assumption of a continuous 12-month EBITDA loss is something we don't particularly agree. And we've kind of challenged the assumptions they've taken on that, but it is what it is.
Yeah, they obviously have they of course have their own methodologies. And we've given them our feedback, but yeah, that's right. Okay, so I'll just briefly take one or two more questions online before we close the Zoom session, but happy to kind of continue the discussion in the room as well. World apparel market is moving from west to east. Are we taking any plans to capture the demand rising from the east? Maybe to look back to you.
So roughly 6% of our revenue comes from the east or non-traditional markets. We would like to have that increase, but it's not as straightforward as anyone thinks. For example, if you want to capture the markets in China, there's a big China for China strategy. So with the current footprint we have, it's not as easy. And when it comes to Australia, Japan, again, duty-free agreements play a major role. India is duty-free to these markets. Bangladesh is duty-free to these markets. So for Sri Lanka to service those markets is challenging. Where we see a lot of opportunity is servicing Brazil, because Egypt by next year will become completely duty-free to Brazil. And Brazil has a big market, which was predominantly serviced by local manufacturers. We've started our first order to Brazil, again, through Castor, where they've signed up a Brazilian football team. And we will continue to build on that strategy and use maybe South America. I think the trade agreement is Mercosur, right?
Yeah.
Mercosur, we will continue to look at that market as opposed to chasing China, Japan, as at right now. But what we do is we service global brands that have retail stores in these markets, and we ship from our countries in like Ethiopia and Egypt that has access to these.
Okay, I'll take one final question from online before we close. Any comments on the trajectory of debt in the upcoming quarters? And the mentioned break-even revenue is for break-even at operating profit or NP?
So the finance cost, we think that it'll be the same, because given our losses that we have funded, so finance cost we don't see it'll increase at a rapid pace, but the break-even level we are trying to at 18 million or 90 million sale is at NP level, not at operating profit level. It's at NP level.
That's good. Okay, I think in the interest of time, we will close the online session. Thank you everyone online for joining. We will be sending out the presentation to everyone on email. This session has also been recorded, so it will be also available to you online as well. But thank you very much, and I wish you a good rest of your day.